Welcome to Future You, a segment to help you take control of your financial future. Today we're talking with Courtney Purl, Risk Insurance Manager at William Buck Chartered Accountants and Advisors, about the limitations of insurance within superannuation. Welcome, Courtney.
Thanks, Paul.
Courtney, most of us are aware that our superannuation fund offers a level of personal risk insurance. But what are some of the key things we need to know about that cover?
So the big thing is you'll find most Australians, or if they haven't looked after their superannuation before, they will have industry super, which will typically have some basic level of cover in there, which is generally an automatically accepted level of cover, and it may be a couple of $100,000 of life and TPD cover, and perhaps if they're lucky some income protection in there as well. The problem with that, they are taking on huge levels of debt these days to be able to get into the property market, the most common scenario. So that level of cover that sits within super is definitely not going to cover a lot of those mortgages that people are taking on, let alone if they've got a family, making sure if they are no longer around, making sure that their family is looked after. Another big thing that people need to be aware of is that those lump sum levels of cover will most likely reduce with age. So as we get older, that level of lump sum cover will be coming down as we get older. And so when we hit in our 30s, 40s, 50s, even into our 60s, some people will still be carrying debt. So they may not have any life cover there to protect that level of debt that's still sitting there. So that's the big thing that people need to be aware of.
So if we did need to make a claim, what are some of the issues we are likely to encounter with the basic level of cover offered through superannuation?
So it can typically be a little bit harder to claim on and take a bit longer to try and get a claim paid. The big thing, especially if there's income protection sitting within super, there can be a restriction on the benefit period in which the income protection benefit will be payable. So often it'll be capped at a 2-year benefit. So that means after 2 years, if you've had a long-term illness, that benefit will stop from the insurer, and then really you're relying on either your personal asset position or relying on a government benefit, which is often a lot less than what people's current standard of living is. So that's a big thing, and also the level of cover that they are insured for their income protection is often a lot lower than if they had gone out and sought advice on getting the appropriate level.
Finally, what would your advice be to people who want to give themselves peace of mind?
Especially for young people, I would encourage them to get their current super statement that they would have got in the last couple of months, have a look there and see how much insurance is actually there. And then I would get appropriate professional advice on, is that appropriate for my situation, and where is my exposure and what insurance do I need to protect myself and also my family if something were to go wrong.
Thanks, Courtney. To find out more, visit williambuck.com and keep an eye out for the next edition of Future You.